Okay, we are going to get started with this installment of the Voluntary Benefits Shop biweekly broker webinar series. I thank all of you for joining us today. Again, my name is Mike Walker. I'm the president of the Voluntary Benefits Shop. I'm coming to you from the city of brotherly love today. I'm in Philadelphia today, and so I have some help with the technology today. Brian's going to be my partner in terms of moving the screens ahead. But for those of you that are not familiar with the Voluntary Benefits Shop, we are your one-stop shop as a broker when it comes to all things voluntary benefits. What we do is when you have a case that you want to talk about voluntary benefits for, we go out to the market, we secure the proposals, we apply our preferred block underwriting offers, we come back to you with the due diligence and recommendation, and then we handle everything moving forward in terms of client communication, employee education, enrollment, and service after the fact. So one-stop shop for all things voluntary. If you're interested in getting some information about today's products that we'll talk about or any other products, my contact information is here on the screen, and our website is below. Feel free to check us out. But we're here to help you, or if you just need some advice on voluntary as well, even if it's not for a case that's for us, like we're always here to help. Okay, let's get started with today's program. So today we are going to review 4 of the more preferred life with long-term care options. Brian, if you could jump to the next slide. So this has become a very, very relevant topic for a number of reasons. I mean, some people are actually calling it a long-term care crisis, and there's really some dynamics that are going on to really make this a very relevant topic. Number one, think about demographics, right? Like there's more people than ever that are over the age of 65 than under 18. So it's just, baby boomers, et cetera, just a lot of people that are part of that demographic that are dealing with, long-term care. Maybe they've had to deal with a parent going through long-term care, or maybe they're worried about like their future and having to go through it. And so that's one thing. Secondly, the cost of care is just, very expensive. The median annual cost for in-home is $55,000. Care in a nursing home is like $95,000, right? So very, very expensive. And then beyond that, even for people that do want to be proactive and protect themselves against that scenario, the standalone options out there are shrinking. There's not really a good a good avenue for group long-term care anymore. On the individual side, there's not very many carriers still in the game. And even on the individual side, people have to go through very, very rigorous underwriting processes, and it can really exclude some of the people that really need it most. So it's just kind of a convergence of scenarios that have made it a much more relevant topic. Next. And there's really a disconnect out there. Some of it's just like miseducation of people. So number one, what the U.S. Department of Health and Human Services tell us is that 70% of Americans over the age of 65 will need long-term care services at some point in time in their life. In fact, the average person is going to incur costs of about $172,000, and that statistic comes from SHRM over the course of their lifetime for long-term care type of services. There's misinformation out there or misbeliefs. Many people believe that either their health insurance, Medicare or Medicaid, or the Affordable Care Act, cover these types of costs. And really, amongst all of those things, there's very, very minimal coverage for any type of long-term care type of services. And then only 32% of employers actually offer a long-term care insurance as an employee benefit. So really a really small subset of the population. And honestly, many of those are the larger companies. So in that small to mid-market, there's very few that are actually offering it. And then when you look at the actual population, fewer than 1 in 3 Americans actually own a long-term care policy. And only 7% of adults over the age of 70 have LTC. So there's not a lot of people in the population that have this type of program. And lastly, it is a benefit that's really one of the more highly requested benefits among executives and highly compensated individuals. So it's something out there that people are asking about. but they don't necessarily have a good, forum to be able to help themselves with it. And so that's what we're here to talk about today. In addition to that, last year there was some legislation out there in Washington State. So not Washington, D.C., but Washington State. They put in this state-funded LTC program, and it was funded by a payroll tax on individuals. And so if you worked in the state of Washington, you were getting hit with this payroll tax. It was 0.58% of your payroll or of your paycheck. And it wasn't an employer tax. It was an employee-only tax that was able to fund this. Now, it funded a very limited program. It was $100 per day up to a lifetime maximum of $36,000, $36,500, so very limited. And the other caveat was that you had to be living in the state of Washington in order to access the benefit. So if I worked in Washington my whole working career, and then I moved to Florida or I moved to Arizona in retirement, and then I needed to access long-term care, I couldn't utilize the benefit. So there was some big issues with it. And the other thing is that Washington State gave people the opportunity to opt out of the tax if they could prove they had an individual long-term care product. So companies, employers scrambled to find that solution last year in 2021, scrambled to find that solution last year towards the third and the beginning of the fourth quarter. And so it was kind of hectic. We actually handled a ton of cases in Washington State that were looking for a solution that would give employees the ability to get coverage to opt out of the tax. And these type of programs we're going to talk about today, many of them qualified for that exemption. So we're going to talk a little bit about that. But the reason I bring this up is, the rearview mirror is Washington State and what happened there. But coming ahead, there's 13 other states that are considering very similar legislation. And you see those are the states that are highlighted here in blue. These are the states that are considering similar legislation. Some of these, California, New York may be coming in the next, year or two. Some of the other ones, soon after that. And there's no telling exactly what their legislation is going to look like. But Washington State was kind of the model that people are trying to improve upon. And so just know that, if you have companies that have employees in those locations, it's something that's going to come up. SHRM is talking about it. Other HR groups are talking about it. It's on the news. It's coming up more and more. So that's part of what we're here to talk about, solutions that can help with that type of scenario. And just more companies than ever are trying to be prepared for it and trying to help their employees with this type of benefit. Next. Okay, so let's talk a little bit about how this life hybrid or these life hybrid products work. And so this is kind of a general outline. It's not specific to any one carrier. But basically, it's life and long-term care insurance tied together. And so at time of death, it's going to work like any other life insurance product does. It's going to pay a benefit to the beneficiary at time of death. Most of the products also have a terminal illness component where they're going to advance 75% of whatever the life insurance is if someone is diagnosed with a terminal illness. So very similar to how your VTL options work for that. But then down below, this is where your long-term care benefits come into play. So some companies, it's called a living benefit rider. Other companies, it's called a long-term care rider. But either way, the way that they generally work is they're going to advance a percentage of the life insurance. So let's say 4%. Most carriers are 4%. It's going to advance 4% of your life insurance monthly until that benefit is exhausted. So in this case, 4%, it's going to pay that benefit for the first 25 months. Now, after 25 months, it doesn't disappear. Many of the carriers have what's called an extension of benefits provision, which then extends the benefit for another 25 months. So you can get a total of 50 months of long-term care or living benefit rider at that same 4% level. And then some of the carriers also have what's called a restoration of benefits provision. So in this specific example, it's going to restore that death benefit up to 25%, even if you utilize all of the benefits for long-term care. So I know that's a lot of percentages. It's a little tough to follow. The next slide is going to give you a real numbers example to kind of help you understand, how that works. So let's go to the next slide, please. Okay, so this is the $100,000 example. Let's say that I was the employee and I chose a $100,000 benefit. Well, if I pass away, I have a heart attack on the golf course and I never need long-term care and I pass away, it's going to pay my beneficiary $100,000, just like any other life insurance product would. If I'm diagnosed with a terminal illness, I can receive 75% of my death benefit right away The remaining 25% would be paid to my beneficiary at time of passing. Now down below, we're going to address the long-term care. So if I'm in a long-term care scenario, it's going to pay me $4,000 per month, 4%, in this case, $4,000 per month for up to 25 months. There is a 90-day elimination period. Benefits would kick in after the 90-day elimination period. And then the extension of benefits is going to kick in after that 25 months. So it's going to extend that same $4,000 per month benefit for an additional 25 months. So I get a total of 50 months of long-term care or living benefit rider. So you can do the math. With a $100,000 policy, with the extension, I can actually receive $200,000 worth of long-term care. And then that restoration of benefits provision, even if I exhaust that $200,000 of long-term care, I still have a $25,000 death benefit that would pay my beneficiary at time of passing. Okay. Now with long-term care, the trigger for benefits is typically the inability to perform 2 or more of the 6 activities of daily living. And you see those activities of daily living listed here at the bottom of the screen. So if I can't perform 2 or more of those 6, then it's going to trigger my benefit. With some of the carriers, it triggers the benefit just with that. That's the only qualification for triggering the benefit. With some of the other carriers, the trigger for benefit may be that, plus I have to be receiving care from a certified caregiver and incurring a cost. Okay, so we'll talk a little bit more about that. Next. Okay, so why are the hybrids overall, like why are they so appealing? So number one, think of it this way, 100% of policyholders are going to receive a benefit. So either they're going to receive the life insurance benefit when they pass away or their family is, or they're going to receive long-term care when they go through that scenario. Versus if I have a standalone long-term care plan, I'm only going to receive a benefit if long-term care is needed. Also, the hybrid plans offer guaranteed issue, guaranteed acceptance underwriting. Typically with a standalone long-term care, I'm going through rigorous medical underwriting and that type of thing. The hybrid programs typically offer more affordable options, and they also typically offer level premiums. Versus on the LTC side, I may be subject to premium increases over time. The hybrid products, many of the products accumulate cash value because it's built on a whole life or a universal life chassis. So it's going to accumulate cash value over time. Typically, your standalone LTC options do not do that. The LTC hybrid products, the life hybrid products, are indemnity style products. So it pays a benefit regardless of the cost of service. So if my cost of service may be minimal, I'm still receiving the full benefit. In some instances, I don't even have to incur a cost of service. And also some of the carriers have the potential to pay claims during informal care. Informal care may be like my spouse is caring for me in my own home. My child is caring for me. My neighbor is caring for me. That's informal care. It does not have to be a certified caregiver. Some of the carriers have products that will pay a benefit for informal care, which is a nice benefit. A lot of people like that. They don't want to be in a nursing home. They want to receive care at their own home. And so they have that informal care benefit. And then the hybrid products are portable as well. So just so that you know that. Down here at the bottom, you have the 4 carriers that we're going to talk about today: Transamerica, Chubb, Allstate, and Trustmark. We're going to touch on each of them individually a little bit and talk about pros and cons. Next. So this is the type of due diligence that we create, for our clients when they're looking at this type of product. So we go out to the market, gather the proposals, and put together. So don't pay attention to this in terms of pros and cons for the carriers. We're going to get to that. But this is the type of thing that we would come back to you with for a client. This is actually one that we did for a school system not too long ago, that the pros are highlighted in green, the cons are kind of highlighted in yellow. Next. So let's talk about the Transamerica product first. So Transamerica offers both the universal and whole life options for this type of product. For universal life, they actually have what's called a high face amount and a high cash value rate structure. They offer a really high level of GI on all size cases. So small cases, large cases, they have a high level of GI. They also have the highest max benefit available. They have a max benefit of $500,000. So it's the highest max benefit available of any of the carriers. They also do have the extension of benefits and a death benefit restoration rider that is available in most states. They also offer coverage for both children and grandchildren, and spouses as well. And they have the ability to pay their benefits for informal care. Okay, so they do cover informal care. And they typically, with our underwriting offer anyway, they have very minimal participation requirements. Points to consider on the Transamerica. I mentioned that they have two options on the universal life. They have an HFA, high face amount option, and an HCV, high cash value option. I personally never offer the high face amount option because it's not really a permanent policy. It's designed to really, it's not designed to fund the policy for the life. So if you're working with Transamerica, I would say make sure you're using high cash value options there. So good product, just make sure it's the high cash value product on the universal life side. Transamerica has no living benefit rider in California or Massachusetts, and there's no extension of benefits rider in California, Colorado, Florida, Maryland, Massachusetts, New York, Ohio, or PA, or Tennessee. They are currently in the process of a new filing that will address that matter in those states, okay? The last thing to know is the LBR rider, the living benefit rider, may not qualify the employee for the LTC tax exemption in applicable states. For example, in Washington State, it did not. Transamerica is addressing that with their new filing. And in some states, it may qualify the way that it is now because it's not finalized yet. But just know, like in Washington State, it didn't qualify for the exemption, but Transamerica is addressing that with their new filing. Next. Okay, so we'll talk about the Chubb option. Okay, for some ages, Chubb's often the least expensive option, and that's really because of the product structure. We'll talk about that. They do have the extension of benefits rider in most states. PA, some of you are in PA. I think PA is to be available at the beginning of next year for the extension benefit. In many states, they have the longest time period for LTC. In some states, it goes up to 75 months. In my example before, you saw a 50-month option. Well, Chubb, you can go up to 75 months, so it can actually pay 3 times the face amount. Pay a little bit more for that, but it is an option. They have a 50% death restoration benefit, and their rider is a true LTC rider, which should qualify employees for the LTC tax exemption in states where that's applicable, like Washington State last year. Points to consider: the product is a permanent term life option. Okay, so it's, again, permanent term. Okay, so it's not a cash value product. Okay, it's term to 100 essentially. They do not have the extension of benefits rider in Massachusetts, Minnesota, or PA. Plan does not accumulate cash value. Another item to consider is they may reduce benefits at age 70 or after 25 years, whichever's later. So I'm always a little leery of that. I really want to make sure the consumer understands that. So it really depends on the performance of interest rates, whether or not they reduce benefits. So that's always a question I ask my Chubb rep, so just make sure you know that. And the plan does not currently cover informal care. It does have to be a certified caregiver for the long-term care benefit on the Chubb plan. Next, okay, the Allstate plan. So Allstate has both universal and whole life options, so cash value options. They offer the highest level of GI for cases under 100 lives. Now, this is on our block underwriting offer. We have the best block underwriting offer in the country. So cases under 100 lives, I still get $150,000 worth of guaranteed issue from Allstate. That's fantastic. They also offer the highest GI for working spouses. Cases under 250 lives, the spouses can get $25,000 in guaranteed issue. Cases of over 250 lives, you can get $75,000 of guaranteed issue for working spouses. Non-working spouses, it's $10,000. They do have the extension of benefits in most states. You can see there's a big list on the other side that they don't have it. They do offer life insurance for children. They do have minimal participation requirements. Their rider is a true long-term care rider, which again should qualify employees for the exemption in most states. And they currently do not have long-term care in the states you see listed here. So there are, a half dozen states where they don't have the long-term care rider. And there looks like about 15 states where they do not have the extension yet. So that's something to be aware of. Now, it goes by situs state. So it doesn't matter where the employee lives. It matters where we situs it, whether or not the employee gets that benefit. They do not have a death benefit restoration. Now, they are filing that currently, so they should have that in states coming up. And their plan does not cover informal care. It does have to be a certified caregiver. Okay, Trustmark, the last of the four. So they actually are right now filing a new product that does cover informal care. The current product doesn't cover informal care, but they have a brand new one that's out in many states that does cover informal care. So they have both options. In New York, They have a rider that's similar to long-term care called convalescent care. So only Trustmark and Transamerica have anything viable in the state of New York. And the Trustmark is convalescent care. So very similar. They do have the extension of benefits rider. They do offer life insurance for children and grandchildren. Their rider is the true long-term care rider, which should qualify people for exemption. And they do have the best integration with Employee Navigator and Ease of any of the 4 carriers, because it does ask the underwriting questions, et cetera, right in Employee Navigator or Ease. It links over and asks the underwriting questions. So if you're doing a lot of business on Employee Navigator and Ease, that's something to consider. Personally, I like to enroll this product outside of Employee Navigator or Ease or ADP. I like to do the enrollment off cycle because this is the type of product that takes a lot of education, but that's just me personally. Points to consider on the Trustmark: it's only a universal life option, so no whole life, no term life, it's only universal life. There are 3 separate options. There's currently no long-term care rider in 3 states, and there's currently no extension of benefits rider, and it looks like about 10 to 12 states. They do offer the lowest guaranteed issue for smaller cases, so just keep that in mind. And some versions of their plan reduce the life insurance by 2/3 at age 70. So I would just, if you're working with Trustmark, I would just make sure that you're utilizing a product that does not reduce the benefit at age 70. The life insurance benefit, the long-term care benefit stays the same, but some versions of their product reduce the benefit by 2/3 at age 70. You can ask them to remove that, and they can. It just obviously makes it a little more expensive, but this is kind of a pet peeve of mine. So when we go out and we do a comparison, we're going to come back and you're going to get a rate comparison that looks like that. Don't pay attention to this. This is just as an example. But again, Chubb is usually the least expensive for some age groups, only because, remember, it's a permanent term option. It doesn't accumulate cash value. Your whole life options are going to be your more expensive, but you're also getting your guaranteed interest rate on the whole life option as well. Okay, so all things to consider. It really is a type of product that works well across industries. So, as an example, here's some examples. We've put this type of product in about 2,000 different clients, but here's just a short cross section. We do a 1,100 person healthcare network. 420 people took life with long-term care. A defense technology firm with 650, 151 people took it. A financial services firm with 400 people, 75 people took it. A trucking company, so it works in blue collar too, 350 employees, 104 took it. Law firm, 220 and 82. Skip down to the bottom, HVAC company with 75 employees, 27 took it. And a 25 person company, we had 10 people take it. So all different size groups, all different industries. It can be a popular product with the right education campaign. Couple of case studies. This is a trucking company, 350 trucking company. We did about 171,000 in premium. That's about 85,000 in comp to the broker. Next, 650 defense technology firm. We did about 212,000 in premium. That's about 106,000 in first year comp to the broker. Next, 400 employee financial services firm. We did about 220,000 in premium, 110,000 in comp to the broker. And then a HVAC company, 33,000 in premium, 16,000 in comp to the broker. So again, next slide, Brian. So employee engagement, we have a whole employee engagement campaign that we put together for this. The most important part of this is the education. So that can include emails, texts, digital postcards, an employee resource center, live and recorded webinars. I'm not going to show you examples of those today, but if you're interested in looking at this for your clients, reach out to me and I can kind of show you what some of that stuff looks like. Next. Enrollment options include on-site counselor assisted, call center counselor assisted, or platform self-enroll, or a combination of all 3 of those things. Next. So this is an example of some of the communications. This was for a Transamerica case. So they're going to get this via email, and it has these links they can click into and watch videos and go to schedule a call with a counselor. So very well put together communication campaigns. Go to the next slide, please, Brian. And then they get some sample communication reminders throughout the course of the enrollment, like, did you know? did you know that the average cost is this? And then they click here to learn more, and they can schedule their call with the counselor. So they get things of that nature to remind them about, the product throughout the course of enrollment. That's all stuff that's really important. A couple of things, just when you're considering putting this on bin admin, with most bin admin systems, it's really clunky. It's not really very compatible with a lot of bin admins because of the rate structures. And when we do put it on a bin admin, the average face amount selected is really low, and you get very limited participation from higher income earners. When we do an off-cycle enrollment and do it outside of their bin admin, we're able to offer more robust options, higher benefit amounts. The average face amount selected is much higher, 75,000, and we get much higher participation from higher income earners and executives. It's just a product that takes a lot of education. So doing it at open enrollment is just as part of a self-enroll doesn't work very well in my experience. One of the things that we do with a lot of our broker partners is we host webinars that you can invite your clients to. So this is an example of a blast that we put together that goes out to that brokers can send out to their clients, and then their clients just click a registration link and can register for one of the webinars. So if you're interested in doing that, reach out to us, and we can talk through that with you as well. Okay, so it looks like I'm right about on time. It's 11:29. Please, if you have any questions, you can enter them into the chat now. I did see that there was a couple people that popped on late. We have this webinar is recorded, so we can provide the recording to you. And so you can get the full education on the 4 different carriers that really have viable products in this industry, or in this or in this product segment. With that, Chelsea, are there any questions in chat at all?
Lisa would like to know, what are the minimum participation requirements for each carrier?
Well, that's a great question, Lisa. Okay, so I'm going to base this answer on my block underwriting offer, right? So with my block underwriting offer with Transamerica, I need 3 participants. With Allstate, I need 5 participants. With Trustmark, it's a little trickier. It's a participation percentage, so it's usually 20%. And Chubb usually around the same. It's around 20%. So Allstate and Transamerica are the most friendly in terms of having low participation requirements. Certainly, the larger the group, the more leeway we can have with that. But on the small group side, Allstate and Transamerica have the lowest participation requirements. Hopefully that helped. If you need more specifics, you can always reach directly out to us, and we can help you talk through that as well. Any other questions in chat, Chelsea?
Nope, that was the only one.
Okay, we'll hold on for a second just to see if there's any other questions that come into chat. Brian, can you go to the next slide? Okay, guys, so we have one more webinar coming up for the summer. Coming up, Trustmark's answer to the long-term care crisis. So we touched on the Trustmark product today. Trustmark is actually going to be on the webinar on the 18th to go through their product, and I'm sure they'll talk about their new product that they just filed that also covers informal care. So right now, the only carriers that cover informal care are Transamerica and Trustmark. They both have a product that will cover informal care. So I'm sure they'll talk about that on the 18th, but August the 18th at 11 a.m. we'll have Trustmark on to talk about their product. Next slide, Brian. Okay, so just quick recap. If you have any questions, this is my contact information. Again, you know what we're here for. We're here to help with all things voluntary benefits for you or for your clients. Handle the whole process from beginning to end. I appreciate your time today. Thanks for spending part of your Thursday with us. And Chelsea, anything new come into chat we need to address?
No.
Okay. Hey, everyone. Thanks again for your time. I appreciate it. Let us know if we can help. This is a real hot, topic out there, especially for, companies that had to deal with it last year because of Washington State or one of those states that are going to implement it in the next few years. Get ahead of it. Let us help you get ahead of it because we have a lot of experience with it. Again, appreciate your time, and everyone have a great rest of your day.